Hello, everyone. Thank you all for joining us on the fourth episode of the Global Investment Society Insight Series. Today, we're joined by Jos from Apollo, and thank you so much for being here today.
Thanks for having me, Arman and Cindy. Happy to be here.
Awesome. And so just to start off, for listeners who aren't as familiar, could you please tell us a bit about your role today and the path that led to where you are?
Happy to. And also, we want to get into what USC did for me along the way, guys, because I have nothing but respect and love for USC. Yes, we'll get to that in a little bit. But my story is born and raised in Denmark. Out of high school, took a apprenticeship program in banking. So it's a little different than the path you all are on, in that in Denmark, we don't funnel the vast majority through a college process. We have lots of options: trade school, apprenticeships, college, that we call university, and other paths. So I actually ended up on a banking apprenticeship program, 2.5 years. At 18, at 20, went straight to sales and trading. I had ventured into our trading room in my first week there and said, this is where I'm going. And by 20, started as a trader, trading FX and rates, and just loved it. It was a fascinating place to be. It was the late 80s. It was all voice, and it was levered arbitrage, making a lot of money for our clients, and of course, also for the bank. So a great place to learn. By 23, I wanted to leave Denmark. I had a few choices to do so. I worked for a global bank, but was asked to go to Los Angeles. We owned a subsidiary bank in LA, and we had a small FX trading shop over there. And they asked me to go over and run that shop. So that's how I landed in California in the US to begin with. 3 years later, we sold that bank, and I called the Danes and said, I'm not coming home. And they said, we know. I went on to actually one of my clients, a super entrepreneurial bank that was basically built on lift outs. So they lifted out my team. I moved my business there and built a great FX trading business for other banks, and of course, importers, exporters, and other, and went on to run a bunch of other businesses for this bank. 6 years later, we sold that bank. It was around 2000. We had a lot of different businesses in the bank, including venture lending. We had warrants and a lot of startups. Those startups back then were eBay and Yahoo and others. These warrants were pretty valuable. So we ended up selling the bank in 2000. I was recruited to what is this, a subsidiary bank of Mitsubishi UFJ. So MUFG is the 5th biggest bank in the world, the biggest Japanese bank. And they own a majority stake in a California bank called Union Bank. 400 branches, big commercial banking roots. And I joined them running basically capital markets and sales and trading businesses. And then over a 10-year period after that, went on to run private banking, asset management, retail brokerage, insurance brokerage, project finance, leasing, a lot of different businesses, kind of a portfolio of businesses. And it was really about growing them, in some cases turning them around, in some cases selling them, in some cases buying other business to really scale them. And it was a super fun experience to really run a portfolio of businesses that all had different needs, were at different points in their life cycle, and incredible learning in that. By 2008, the financial crisis rolled around. And as the financial crisis rolled around, a few things were going on. At our bank, at Mitsubishi UFJ, we were clean. We were not in need of government support. And of course, when you have a situation where there's such distress, it's a fantastic opportunity to play offense. And offense for MUFG was a couple of things. Privatizing Union Bank, they were 2/3 owner. They took out the last third and integrated it. And secondarily, as you remember, during the financial crisis, Lehman fails that afternoon on a Sunday. B of A takes out Merrill. A week later, Warren Buffett comes in and supports Goldman Sachs with a convertible preferred $10 billion rescue package for them. And a week later, Morgan Stanley was next in line. MUFG came in with a $9 billion investment, same format as Berkshire Hathaway's investment in Goldman convertible preferred, and basically rescued Morgan Stanley with that $9 billion investment. That investment turned out to be one of the finest investments, and during the financial crisis, it's worth $40 billion today. And more importantly, MUFG has just, and Morgan Stanley has had incredible synergies between the two. The reason why I bring that up is by 2009, 2010, I was then asked to go to the parent company in New York, so MUFG in New York, and do a couple of things. Integrate Union Bank with the parent. The parent was a corporate investment bank in North and South America, and basically create a single bank out of that. And at the same time, oversee the relationship with Morgan Stanley in the US, not globally, but in the US, and just figure out ways that we could work together, synergies of the transaction we had done, and ways we could create value together. I did that in the capacity of CFO. That's my first round as CFO. I had run businesses up until that point, and found myself in a CFO role and had to learn what it means to be a CFO. And about 3-4 years later, we had integrated the businesses. I went back to run investment banking and markets for North and South America, and then took a broader CFO role by 2016, 2017. In 2021, 22, I left the bank, and I was recruited to Apollo Asset Management, and I took the CFO of the asset management side of the house. We have a world-class alts asset management business. We have a world-class retirement services company under Athene. We have a holding company up above, and I have the asset management side of the house as CFO, and have been in that role for about 3 years. So that's kind of my story along the way, if that answers your question, Arman.
Absolutely. Yeah, that's a fantastic journey, and it was incredibly detailed and very interesting place of, especially in the financial crisis, that $9 billion investment being super valuable today. So going back to your first comment.
I should say I didn't make the investment, Arman. I take no credit for it. Yeah, I did come in to help. I did come in to help monetize it, and nothing but respect for doing that deal. Maybe stay with that deal for a second. So the reason why that deal happened was, of course, for MUFG, this was a hole in their offering. Investment banking, M&A, somewhat securities businesses globally was not a strength. This is a way to turn that into a strength. So it was just a fantastic transaction for them at an opportune time. But it was a risky transaction because back then we had no idea what was on that balance sheet of any of these investment banks, and there was a lot of questionable stuff in there, real estate and other. So it was a risky transaction that really paid off both strategically and financially.
Absolutely. Yeah. Thanks for that clarification. That's very, very interesting. I think going back to that first point you mentioned, which is, you wanted to bring up the USC angle. As a USC alumni, let's talk about that, right? How did your time at Marshall and at USC shape your leadership philosophy, and especially your approach to leadership within financial services industry and financial strategy?
Yeah. So USC was a bit of a game changer for me, guys. So I went through the evening MBA program. So I had done my undergrad and wanted to be in a world-class business school. I was living in LA. There was only 2 choices, and the choice was easy. It was going to be USC. So I ventured to campus in South Central a couple of nights a week, and just immersed myself in that MBA program with a few different objectives. One objective was really take to the office what I learned at USC, take to USC what I had going on in the businesses. I was running that portfolio of businesses at that time, and it was super synergistic in terms of being able to leverage both ways what was going on. That's the benefit of a part-time MBA program. So a game changer. It also gave me a much broader horizon than what's going on just by virtue of everybody else in class with, and really saw some super high quality people, interesting careers. And then it made me a fantastic time manager because we were working like dogs and we were going to school at the same time. So it turned out just to be a great experience. I was in LA earlier this week. I actually flew in this morning. And out there, I saw your Dean Garrett. I saw Jeff, and I think you guys are led by a world-class dean in Dean Garrett. I've seen him a couple of times lately, and one of the things we were talking about out there was really the whole dynamic of world-class academics, but USC's focus also on, guess what? We have to bridge to a paycheck. We have to bridge to a great career for anybody, whether coming out of undergrad or graduate school. And I think USC probably does that better than many other schools, that they have that practical focus of how do we actually leverage this great academic degree that we're coming out with. And I think that's a hallmark of USC, in addition to innovation, in addition to entrepreneurship. So I immersed myself in entrepreneurship classes and other things when I was there, and frankly, just really enjoyed it. And it opened my horizon and frankly shaped me. I would not be where I'm at today had it not been for my experience at USC.
Yeah, thanks for sharing that experience. Team Gear has been very helpful for our clubs as well. So it's great to hear that you guys caught up. Moving focus to Apollo, we all know Apollo is one of the most complex and globalized platform in finance. So we're curious to hear, how does your day-to-day look like as a CFO, and how do you approach managing scale and diversity in a big firm like this?
Yeah, great question, Cindy. So maybe just frame it a little bit. What is Apollo? So Apollo is of course an alternative asset manager. We're about 35 years old. We have close to $800 billion worth of assets at this point. And inside that 800 billion, we have a market-leading credit franchise, the biggest on the street, 600 billion or so. We have a fantastic private equity franchise, which is what we were born in when you think about it 35 years ago. We're on our 10th vintage flagship fund in that, and have created incredible returns for investors. We have expanded into infrastructure. We expanded into renewables. We have a secondaries business, and we have a fantastic real estate business also. So that's the asset manager. Then our sister on the other side is then Athene, which is our retirement services business. And in Europe, we have a equal business, which is called Athora. So what you have under the umbrella here is a big balance sheet that basically creates lifetime guaranteed income to a bunch of retirees, which we find incredibly important to our mission. The assets are then managed by Apollo. And then, of course, we also have third-party assets. So majority third-party assets, but a big chunk of our assets are related to basically annuities that are sold through Athene, where we create that lifetime guaranteed income to annuity holders. So when I think about going to work every day, I think about basically three things. As CFO, number one, enable revenue growth. This company has grown 15-20% for 35 years. We have no reason to believe we can't continue that. So when you have that level of revenue growth in a company, great things happen. So really continuing that revenue growth is important. You do that by scaling existing products. You do it by expanding the product set. We can talk a little bit about that in a second. And really innovate. We have so many places where we can create value for investors, and that's what we do. So that's number one, enabling revenue. Number two is then scaling the firm. So as a firm, we want to drive revenue faster than we want to drive expenses and create operating leverage and scale. We do that by leveraging, obviously optimizing our resources, our people, leveraging data and technology. We have built a fantastic platform in Mumbai, India, that is not a captive, not a factory. It is an Apollo office with great people who have great careers. And we get crazy leverage out of that, having done that over the last few years. So scaling the firm is priority number two. Priority number three is then do all this stuff safely and soundly. Make sure that we don't trip up. And tripping up can be different kind of risks. It could be a regulatory risk, it could be a financial risk, but it can also be a reputation risk. We are super sensitive to continue to maintain this reputation that has been built over 35 years. So managing the risk safely and soundly as we grow that rapidly, as we scale the firm, is then the third priority. So I think a little bit about CFO-hood, if you will, in that context of those three priorities. Make sense?
Got it. Yes.
All right.
Well, as a CFO, like you mentioned, the third point, besides, double-digit revenue growth, managing risk, how do you prepare Apollo in such, an interesting time where have navigate the shift in interest rate, regulatory frameworks, and also just secular changes in capital flow?
Yeah, it's a great question, Cindy. So And the simple answer is we're made for this. We're made for volatility. We are super nimble, as big as we are. We're super nimble to really react to opportunities in the market. Good example is what has happened, say, the last 30 days here. Mid-February, we came into all-time tight credit spreads. Everything had been ground to all-time tight credit spreads. And then, of course, Trump surprised on Liberation Day with the tariff announcements. That created a lot of volatility. Credit spreads blew out very significantly. We, in turn, took advantage of that. We took advantage of that by buying a bunch of credit, typically around the public markets. Private markets did not blow out as much. And we bought some of that credit for our balance sheet, meaning for Athene. We bought it for our funds to really deploy capital that we had raised in our credit funds and other. And we were probably the single biggest buyer of credit in that period. So Apollo is made for volatility. We're super nimble, we're founder-led, which means we can make decisions very, very fast. And so whenever there's times of stress, we think of it as times of opportunity where we can actually do something really, really smart for our investors and create alpha. Alpha is what it's all about for us. There are beta managers out there that create market returns. We have to create risk-adjusted return above beta, and in other words, alpha. That's what our clients' expectations of us are, and that's what we go to work for every day to make sure we continue to create alpha. And we have for 35 years, and we will continue to do that going forward. So volatility is our friend, and you just need to be ready for it. You need to be set up for it. You need to have dry powder. And conversely, in some cases, you have to go the other way and de-risk in certain periods as well. And that's really one of the strengths of the firm is that we are that nimble. We can make very big decisions in a very short period of time.
Awesome. And I think when you were explaining the structure of Apollo, you mentioned the sister company of Athene. I think Apollo has a very unique integration of the asset management side, the retirement services provider side. For your role specifically, what financial oversight requirements are there that might differ from other asset managers in traditional private equity or asset management firms overall?
Yeah. So on the asset management side, we're an SEC registered investment advisor. We have a broker-dealer, and that's a FINRA regulated broker-dealer. We have several broker-dealers. On the insurance side, we have the state insurance regulators and a few other regulators, of course, to make sure that the annuities we issue, the annuity holders can safely and soundly rely on their typically lifetime guaranteed income out of that annuity, or until it lapses at least. So it's a different regulatory regime we have there, Arman, between each one of them. But what's interesting, though, is the synergies between the two. So we are the asset manager for the retirement services company. Our alpha becomes the return on the annuity side, and also allows us then to decide where we set pricing on annuities. So it's a 95% investment grade balance sheet and a 5% alts balance sheet we have there with massive excess capital. So we operate under each of these regulatory regimes, but with that balance sheet, we have the ability to then be aligned with our investors in the funds. And that means that when somebody comes into one of our funds, we are typically a very large investor in that fund, in that asset class, or even in that transaction. And that in turn means if somebody want to raise capital, it can be a large, it could be Intel wanting to raise capital for a semiconductor facility. We can do a very large financing around that. And as we do that financing, we will take down half of it ourselves, 40% ourselves. We'll put 30%, 40% into our funds, and we will sell the rest maybe in our capital markets business. And that means that investors know that we're actually aligned. We eat our own cooking, and we're not just trying to sell them something as an asset-light asset manager. We're not asset-light. We have a $300 billion balance sheet that we own 100% of. But that alignment is incredibly powerful, that our investors know that we believe in what we do. We actually own the risk ourselves, and that is super compelling for an investor to invest alongside us with that in mind.
Makes complete sense. Being aligned with your investors is, I'm sure, incredibly
key for us. Yeah,
absolutely. And going back to that one phrase that you mentioned, which was that Apollo is still founder-led. I know Mark Rowan speaks a lot about encouraging intellectual insubordination at Apollo. And for you, what does that look like in practice at the leadership level as a C-suite executive?
Yes, it goes a little bit to culture of the firm, and we have a pretty magical culture. It's a culture of obviously ethics, values, unquestioned. It's a culture of collaboration. It's a culture of honesty and open communication. And as part of that, we have this term that I think Mark has coined, which is intellectual insubordination, meaning in any session, anybody can speak up and say, I disagree. I have a different view. That can be in an investment committee. It can be in a leadership committee that I sit on. So by having that open communication, you get everybody's point of view, and you typically get to a better place. So I think it's Mark's coined phrase, intellectual insubordination, and it's alive and well at Apollo to make sure that we actually listen to everybody's point of view and get to the right decision in part with a broad set of views.
Absolutely. Incredible. So looking ahead in terms of how Apollo and the entire asset management sphere, especially alternatives, is expanding, I think another big angle is providing institutional quality products for retail investors. And that includes alternatives and providing access in that sphere to retail investors. What do you think are some operational or regulatory hurdles that Apollo is actively solving, and even including on the asset management side for you?
Yes. Good questions you guys came up with, Arman. My compliments to you. So the alts managers, us and the other large alts managers, are all born in institutional capital. It's pension funds, it's states, it's sovereign wealth funds, but large kind of elephant hunting chunks of capital where you have a relatively simple client on the other side. As we go into wealth, and we've gone into wealth very significantly, and I have an incredible success in it, it's different. It is two-legged individuals, typically approached through channels. Channels can be registered investment advisors, broker-dealers, private banks in Europe, and other. And so by definition, it's more complicated. It's also more complicated in the vehicles with which we serve them. We can serve them through a publicly traded business development corp, a publicly traded REIT. We can serve them through what we now call semi-liquid funds that have a defined level of liquidity every quarter, not 100% liquid, but maybe 5% exits every quarter. So in order to serve two-legged individuals and serve the channels with which they bank or manage their wealth, you need to show up basically with a lot of different flavors so that it fits their need. It could be tax deferred. It can be, in some cases, in an annuity wrapper. It could be, in some cases, in it, or hopefully going forward, in a defined contribution plan or other. So it's a complicated place to serve, and that creates a little bit of barrier to entry for the smaller or mid-sized firms. It's also about brand. You have to be super credible in that channel and have a fantastic reputation, as we do. On our website, we have something called Apollo University, where we actually educate a lot of advisors out there in what's going on in the markets, in what our products are all about. We have an incredible success with the education side, because reality is thousands of advisors are deciding whether to sell our product or somebody else's product every day. And out of this has come a fantastic wealth business. We started in earnest 3 or 4 years ago. It's growing very, very fast, and it is a massive market. There's nothing but upside in that market. So super focused on it. We're still raising lots of capital institutionally, but the fact that we have the wealth side is a beautiful thing because it diversifies the business.
Yeah, moving forward, I think you also hinted it in the beginning, and Mark has spoken extensively about the structural shift from banks to private market and credit and retirement income. So from a CFO perspective, how is Apollo navigating this transition both operationally and strategically?
Yeah, great question, Cindy. So think about it. We're a little bit brainwashed as individuals, as investors, that public market is a beautiful thing. You know the price of everything every day or every minute. There's liquidity in that, whether it's a bond or stock. Reality is that the vast majority of credit is private. Most companies are private. Most companies are unrated. So the private credit market is many multiples larger than the public credit market. And that'll always be the case. The notion of liquidity has also changed. So post the financial crisis, banks have much less trading capital, and therefore liquidity has actually been drained out of public markets. It takes 5 days to sell a bond today. Equities have good liquidity typically, but credit doesn't. So the whole notion of you can only invest in a fund that has public debt because it has liquidity doesn't actually hold anymore, because it doesn't have much liquidity. So now you can go in and have a much broader swath of the debt market when you think about it by investing in private credit. We have stepped into that space and provide private credit solutions to companies of all sizes. And when I think about our $600 billion worth of credit assets, sure, there's a big slug of public debt in there, but what differentiates us is just incredible access to private credit. How do you get access to private credit? Well, you create it in part. We have about 16, 17 lending platforms that basically lend out. It can be an aviation finance company. We have a ABS structured finance company in Atlas. We have Wheels Dunlin that does basically truck leasing and financing. We own these platforms. These platforms finance other people. The loans come out of that. Those loans then get put on our balance sheet or with our funds or gets distributed into the market. So in order to play in this space, you have to basically eliminate most of the intermediaries and have direct access to it. And that's what we've been doing. We also have great partnerships with banks. We don't want to bank these companies. We want to finance them and then take that financing and put it into an earning asset for our funds or for our balance sheet. But in the relationship with the banks, the synergies between us and the banks is that the banks want to bank the client and they're great at short-term financing. We're good at term financing. So if you want to have term financing for a 7-year project, a 10-year project, that's not really a great fit for the banks. And that's where we can come in, because on the other side, we have long-term investors, or we have issued long-term annuities, fixed annuities. So we have the duration match of providing long-term capital for solutions like that. So we have great synergies between us and the banks we work with. We sell our products into their wealth businesses, and we also partner with them when we do financings. So the alts managers have become a super important part of the ecosystem. Think about it. The capital markets were banks, it was insurance companies, and now the alts managers like us. And that creates super dynamic market, finances corporate USA, corporate Europe, parts of corporate Asia as well. And that's really what has happened in the last 4 or 5 years, especially in and around private credit.
Yeah, definitely. And besides, the financing history, Apollo has benefited from just identifying long-term macro trends early on, especially the retirement gap and then also the institutional credit demand. So my question is, what kind of thematic themes or trends do you believe that are being overlooked today?
There's a couple of things, Cindy. So you brought up defined contribution of 401ks. So think about 401ks. We've been brainwashed to have, again, liquid products in there. You guys you're gonna start your job out of college here, Cindy, in about 10 minutes. You're a senior, you're graduating shortly, you have your job lined up. Congratulations on that.
Thanks.
You'll be starting your 401k next year. In that 401k, historically, you would put public stock and bonds. And of course, we're asking, why would you do that? You're not going to retire for 40 years. Who cares that you have daily liquidity in that? why not have a mix of some alts investments in there that may have less liquidity to them, but a higher return? You get paid a liquidity premium for having it in there. I think we're doing people a disservice to not have a broader set of offerings available in 401ks in the defined contribution market. That's one trend I think is going to change. That doesn't mean you should put super risky stuff into a 401k offering. You have to have high quality, good return products in there, and that's in part what Apollo offers. So there's a trend in and around defined contribution. There's a trend around wealth. We talked about wealthy investors have not had access to alts investments in the past. Why not? Now they do, and they're embracing it, and you'll see a higher and higher percentage in different alts investment, high quality credit products, maybe hybrid products, in some cases traditional PE products as well. We'll see a lot more of the wealthy and mass affluent individuals have access to alts products. A third theme is around lifetime guaranteed income. As you get up in your 50s, where I am, I don't have a pension. I haven't had a job where I have a pension there for the rest of my life. I'm going to have a paycheck come in. I have a 401k, but at some point I want to have predictability in what my annual income is going to be. And that means I want to have some kind of lifetime guaranteed income product where I know that if I put $1 million into that, I would get $60,000 or $80,000 out of that for the rest of my life or my wife's life. So the whole notion of lifetime guaranteed income is a bit of a hole in the system here. We think there's going to be much more demand for that. Every day we hear about people outliving their money. They outlive their money because they don't have that product in their mix. That's what we can provide in part through a theme. So those are just three themes, Cindy. There's other themes than that, but I think those are pretty important that we're pursuing, and massive markets, when you think about it, that are just ready to be penetrated and to meet the need of clients. We want to be on the forefront of that.
Amazing. And as you've spoken about through this time, you talked about how you've been leading through times of volatility and transition, especially during your time managing investment banking and markets across global regions. What is one key lesson that you can share with us about leadership as you've dealt with those transitionary periods?
I think the key lesson for me is always in times of stress, you want to make sure that you have the ability to play offense. You want to have the ability to stay calm, lead your people through it, but also say, all right, so if everybody runs in that direction, I should probably run in that direction. Do I have the slack, the leadership? Do I have the stomach to do that? And if you do, you can do amazing things. So I think you have to be super focused on what action you can take in different scenarios, and especially during stress. The example of what MUFG did during the financial crisis, example of what we do on a regular basis at Apollo. So I think that mindset is really important. It takes a little bit of leadership skill because people get nervous at that time, and so you have to lead through it and motivate people through it and make them see that as an opportunity. And so that's an example of that, I would say, Arman.
Awesome. Yeah, and going towards the future, looking ahead, what excites you most about Apollo's futures and especially your own journey moving forward with the firm?
So I think what excites me the most is, as big as we are a very small player in a number of the markets that we play in, which just tells you that we have incredible upside. It can be wealth, it can be defined contribution, it can be tax deferred, it can be lifetime annuity income, and so forth. There's so much upside for a firm like ours if we continue to differentiate ourselves, and we will. And differentiating ourselves is about alpha, not just beta. It's about creating investment returns for our clients. So many companies operate in markets where they're number one or two, and they have massive market share. This is very, very different. There's incredible opportunity in the markets we operate in. And we are insignificant today in many of these markets. And we will be 3 or 4 or 5 years from now, but we may have doubled or tripled our business and taken some share. So this is a business that has a lot of upside because we really meet a need of clients that they probably didn't know they needed until we showed up and made our products available to them. And that's the most exciting part. You want to work for a growth company. Apollo is a growth company. Our growth story is real, it's proven, but more importantly, it'll continue going forward. Because of that reason, we have lots of areas we can win.
Amazing. Yeah. And Apollo is a growth company. And so how do you think about balancing risk management with innovation as you think and look to expand Apollo's practice beyond new asset classes, geographies, and encompassing new trends?
Yeah. So I think it comes down to the ecosystem. So innovation is hard. We build a lot of new products. We build a lot of complicated products, but we do it with the lens of go to market safely and soundly, make sure that your infrastructure can support it, make sure you have covered your bases, make sure that you're firmly on the right side of compliance with regulatory requirements. So we have a very kind of balanced approach to growth. If you end up letting the front office just launch a bunch of stuff and see how it works, but your infrastructure hasn't caught up with it, you get in trouble. We have a super balanced approach to it. We have governance around our innovation. And that means that when we go to market, we have thought through and covered our bases and made sure that it's appropriate and it's going to work. Mind you, at the same time, we move really, really fast. So the pace at which we can bring something to market is remarkable, in part because we don't have a lot of bureaucracy. We can make decisions quickly and we can just go. We also have incredible brain power. I get to work with some of the smartest people in the business. And that means that when you hit an obstacle, you always hit an obstacle when you innovate. There's such confidence in Apollo that we will find a solution to that, and we always do, and then we move on. Whereas other companies say, yeah, what can go wrong? What if we hit this and this and this obstacle? The mindset here is we know we're going to hit the obstacles. We know that we can find a solution to it, and we just deal with it. We deal with it in real time at a very rapid pace. So we can go to market very quickly after we make a decision. And that's one of the strengths of this place.
And moving on the topic of technology, whether it's data analytics or automations or even generative AI, how does technology shape your approach in just financial oversight or decision-making at Apollo?
Yeah. So we, like many others, are students of this AI revolution that's happening as we speak here. We're active students, meaning we're simply not a technology investor. We don't have a venture arm. We may invest in a manager that is and be along the journey for learning about it. We try a lot of things. Let me just unlock my screen here. We try a lot of things ourselves, find the right use case, and say, all right, let's figure out how we can put AI to use. In a business like ours, where you have 700 funds or so, you have literally hundreds of thousands of individual investments. You have incredible ability to leverage your data, but it warrants that you have your data under control. So we spend a lot of time on making sure we have our data in the right place, so we can actually leverage it. We then leverage it to automate part of our processes. We don't do a lot of AI-based decisioning on the investment side. We use judgment. We have world-class investment professionals that use a good judgment. We're not a quant shop like a hedge fund or other. But we can leverage that data because we have incredible information inside our investment portfolios, inside our client base, and so forth. So for us, it's early days. There's a number of use cases that we have identified that we are starting to see benefits from. But it's a learning journey for us like it is for everybody else. There's much more to come on that front.
Got it. And speaking of learning journey, we'd like to close this out by asking the last questions. do you have any general advice for young professionals and students like ourselves seeking to break into the financial service industry, and just general tips?
Yeah. So Cindy, can I talk about where you're going after this? Is that public knowledge? You're going into a global bank. I can say that, I assume.
Yeah.
Yeah. So I was on the same path. Create option value is my first advice. You go into a global bank, you may you may start out in a part of that bank on investment banking side or sales and trading side. Reality is there's so many places you can take your career. You can make your mark for a couple of years and wherever you start out, but at the same time, keep super open mind on what else exists on that platform that you could do next. As you do that, you build your relationships with people. People want to talk about what they do, so you can pick up the phone and say, can I spend 20 minutes with you and hear what you do? Build the relationship, give these people a taste of you, and maybe secure the next rotation for you. I'm a product of rotations. In my whole life, I have rotated different jobs. And it does a couple of things for you. It keeps you humble because you're constantly climbing a really steep learning curve. And I fundamentally believe that the human nature is best when you have your back against the wall. That's the best learning you have, where you can fail and you don't know everything. You're uncomfortable and you have adrenaline in your veins and you learn 2 years, 3 years of learning every year. So my recommendation to you guys is find the right platform that has option value. May not be the job you go into. 2 years later, that could be a very different job. But find a platform that has options for you to figure out what fits you. Build a relationship with people so they get a taste of who you are and you get to learn from what they do. And make sure that the second that learning curve starts flattening, you're on to the next thing. For people like smart people coming out of USC, you have the chance to get 3 years of learning every year, and 10 years later, you got 30 years of experience. That's where careers are made. So some combination of option value, steep learning curves, and the relationship building is probably the most important factors for the first 10 years of your career. A lot of that still exists at my age. My learning curve is still steep here. I still have my back against the wall on things I just don't know that I have to make a decision on and move forward. And it's just a super healthy thing to constantly learn and grow as individuals. So I'm addicted to it. I'm addicted to learning, and I probably always will be. So focus on that would be my advice.
Got it. Great. Well, thank you so much for the podcast. We enjoyed learning about your insights and your career journey and your role at Apollo. Just want to say we really appreciate your time and we really enjoy having you today.
Yeah, I feel the same. Thank you so much for including me, and best of luck to you guys with your careers. Enjoy Copenhagen, Arman. You'll love it. Okay. Thanks for having me.
Thanks.
Thanks.